Hello and welcome to another episode of Darwin Investors. All right, it's my first time back in a couple of weeks. We're trying to sell the house, and the realtor keeps telling me that I have to leave because I can't sit here and talk into this camera while people are trying to look at the house. And so this video today, I think, is one that just I have to make because it's a getting back to basics video. You know, I talk a lot of macro. I love talking macro. I feel like when you go on the television, you look at what they're talking about, it's basically macro. But what I think we're doing is I think as a stock market society, we're kind of losing a little bit of focus on what the stock market really is, which is to buy great companies at a good price. And though you have ups and downs, ultimately in the long run, the market actually does trend upward. So you will make money eventually, but just not necessarily in the near term. And so that's what this video is going to be about. So I'm going to manage a couple portfolios. One of them's an investing portfolio. That's what I'm going to get into on this video that I've never really spoken about because what's there to talk about? It's just a well-diversified portfolio with a bunch of boring stocks, but it has performed really well this year. And I'll also talk about my trading portfolio as well because it's got some interesting trades that I have in the works right now. But I talk about that one because that has stuff that people don't necessarily know how to do. You know, people don't necessarily know how to sell calls, sell puts, and that sort of thing, but everybody knows how to buy Home Depot and just leave it there and forget about it. And so I talk about the trading portfolio because personally I just find it more interesting. Now, also in this video, I'll be talking about my USOI position. As we know that Credit Suisse went under, so what happened to my USOI position? Because I think the people might have some questions about that, and so I decided to go ahead and give an update on that in this here video. But before we dive into that portfolio, let's first talk a little bit about macro because that's what I believe is causing people to just think a little bit too much about this market. So the last couple of years in the market has been like a gift to those of us that really want to learn the inner workings of the market. I mean, we've had everything. But here recently, we've learned that the bond market is the real stock market. We've learned that the bond market can increase and decrease the cost of capital. And if the cost of capital goes up, then value stocks will outperform growth stocks. And then that's almost like irrespective of the earnings that come in on the growth stocks, because like last year in 2022 with all these tech companies, the earnings were fine, but the stocks took a beating. I think NASDAQ was something like 30% last year. And then this year, people are looking at the rates are coming down, or at least that's the way it's forecast. And that's making growth stocks outpace value stocks. And again, irrespective of the earnings, because we're looking at the oil companies, just astronomical earnings, but those stock prices keep coming down because they're looking at rates. And when rates come down, the cost of capital goes down, so growth stocks go up. We also learned that inflation is very good for value stocks and commodity stocks in particular, be they oil and gas or minerals and mining or whatever, that when inflation goes up, we really want to be in value and commodity stocks in particular. We've learned that banks borrow on the short end of the yield curve and they lend out on the long end of the yield curve. And so when the lending becomes more expensive to the bank, that tends to tighten up the economy. And ultimately, that's the reason why a yield curve inversion causes a recession. It's because there's not as much money pumped out into the economy by way of the banks. And we've also learned about the power of the short end of the yield curve. If it goes up too rapidly, then the banks suddenly get competition from money market funds and people who want to put their monies into the US Treasuries on the short end of the curve. So this can cause a possible liquidity crisis at certain banks that aren't prepared for such a thing and cause certain banks to go under at the worst, and at best cause credit lending standards to really tighten up quite a bit, further causing the economy to slow down. We also learned that if you put money in a bank in excess of $250,000, that your money is actually at risk. These aren't things that I thought about before, but really when you put your money in the bank, it just kind of boils down to you're giving an unsecured loan to a highly leveraged counterparty who may lose some of your money. You may get it back, you may not. Another reason to put it into money market funds and into treasuries. So that's a lot of things about the macro, but it's not actually what this video is about. Because at the end of the day, like I said before, the stock market's about buying great companies at a good price. So how do I feel about this market right now? Let's go ahead and get into that. So I believe that the stock market is a relatively safe place to put your money right now, and I believe this for a few reasons. One is that earnings seem to be kind of like coming in okay. They're not great, but they're fine. The consumers don't seem to be panicking when you look at who's buying stuff from that PVH last week or Lululemon or whatever. Consumers don't seem to be panicking, and the last reason is because bank regulators and the government seem to step in during this entire what could have been a financial crisis, but like limited it to a few banks, which I guess is kind of normal to have banks go down from time to time. But to us, it hasn't happened in a few years, and those of us that are only just recently paying this close attention to the market didn't know what was happening at all. Now, but there are some red flags out there. One of them is Fed borrowing. So these banks are having to borrow money from the Fed through something called the discount window. And we can see that banks are borrowing at a less rate week after week. However, the bank term funding program is going up week after week. So what is the discount window and what is the bank term funding program? Well, the discount window is a central bank lending facility meant to help commercial banks manage short-term liquidity needs. Now, their short-term liquidity needs seem to be going down week after week. This is good news. We saw that in the last chart. Banks that are unable to borrow from other banks in the Fed funds market may borrow directly from the central bank's discount window, paying the federal discount rate. So in effect, the banks aren't having to borrow as much from the Fed at a discount rate now as they did, say, a couple of weeks ago. However, this is the number that seems to be going up, which is the Bank Term Funding Program. Now, the Bank Term Funding Program is an emergency lending program created by the Fed in March of 2023. They just created this thing to provide emergency liquidity to U.S. depository institutions. I had no idea this sort of thing was going on right now, but right now, like I said, the regulators and the Fed are trying hard to avert a total financial collapse right now. One of the ways they're doing this is through this Bank Term Funding Program. It was established in response to the sudden bank failures of Signature Bank and Silicon Valley Bank, which were the largest such collapses since 2008 financial crisis. And what's alarming is if you look over here at this rate here, is that one does seem to be going up week after week. So people are taking advantage of this bank term funding program. So to me, that's a red flag. So banks taking advantage of the bank term funding program and the fact that short-term rates keep going up, so their borrowing rates are going up, are leading to tighter lending standards here. So when we look here, the Fed Senior Loan Officer Survey shows that banks are tightening on their lending standards right now. You can see that in Q1 of 22, it was minus 15%. They were very loose lending at the beginning of 2022, but this has slowly ticked upwards. So right now, 45% of banks say that it's more difficult to obtain a small business loan, if you will, now than it was, say, relative to Q1 of 2022. And this is causing the economy to slow down. And this is also making it so the Fed doesn't have to hike rates as much, because the banks are kind of like a self-regulating mechanism that's actually keeping inflation down by kind of just slowing down the economy in general. And so this is leading many to believe that the Fed might actually be done raising rates, at least for the time being. When we look at the probabilities for rate hikes on the 3 May 2023 Fed meeting, we can see that it's a 51% chance right now that there's no hike at all, because right now we're sitting in the 4.75 to 5% range. And they're saying that at that meeting, there's a 51% chance that there's going to be no rate hike at all. However, there are factoring in about a 48.4% chance that there will be a 25 basis point hike. And this has changed a lot over the last few weeks as a result of some of these banking crises. You can see that 1 month ago, like on 1 March, we had a 30% chance of a 50 basis point hike, a 0.7% chance of a 75, a 0 point chance that they were going to pause rate hikes at all, and and a 68% chance that they were going to do a 25. And you contrast that to several weeks later or 1 week ago, and we can see it was an 83% chance that we were going to do a pause and a 16.9% chance that we were going to do a 25 basis point hike. But now it's more of a 50-50, because as the banking crisis comes more under control, they're thinking, well, maybe the Fed will go ahead and hike these rates, although I don't believe that they should. Now, another reason that I'm pretty bullish on this stock market has to do with this AAII sentiment survey. And what we're seeing here is that on the 29th of March, there was a 22% of everybody was bullish, 45% were bearish, while 31.9% were neutral. And we can see that this number has been on an extreme for quite a while. And now I like extremes. Now this is fine to me. 19% is all right. I actually prefer 19 over 22.5. The historical average is 37.5. But the reason why I like these sorts of extremes, at least for like markets like this, is because sentiment is awful. But what this tells me is everybody that was going to sell has sold. But it also tells me that no one's really out to buy anything either. And so this leads me to believe that we're going to have a pretty flat market. So if you had to ask me where I think this market's going to be or where it lands, you put me firmly right here in this gray area of the neutral. I'm part of this 31.9%. I just don't see a reason to sell, but I also don't think that people see a reason to buy either. And so I think this is a pretty stable market. So what's been performing well, and where do I expect this market to go? Well, one way to do it is to actually follow the hedge funds. And the hedge funds have actually been plowing in their money into like mega cap type stocks. So if you look at the S&P 500 here, say year to date, we can see that we're up 7.46%. Now, if we compare this to an equal weight ETF, such as the Invesco S&P 500 equal weight ETF, which is RSP, we can see that year to date, that the S&P 500 market weight ETF is up 7.46%, while the equal weight is only up 2.48%, indicating that that people are putting their money into the biggest market cap stocks. So this means that the top 10 is way outperforming the bottom 490. And so that's people flying to safety, because you have banking collapses happen and they're saying, hey, let's put our money where the most money already is. We can't put it in a bank. Let's put it into Apple, Microsoft, Google, and the like, right? So what's in store for us next quarter? Well, the hedge funds like this. Right now, this is a big survey of the hedge funds, and what they like is 34% like the high dividend stocks here in Q2, 22% like healthcare, 16% like financials, 16% still like the mega cap tech stocks, and 12% like the energy stocks. Now, some of these will overlap. Some of these healthcare stocks are also high dividend stocks, as are financials, as are energy, not so much mega cap tech. What I'm doing right now is I tend to put a lot of it into the oil stocks. And I said earlier in the video that commodities do well in times of high inflation. And though inflation is coming down, it is still relatively high. So I don't mind leaving it into commodity stocks such as ConocoPhillips or Chevron. However, they do pay a great dividend. They do trade at a significant discount to the S&P 500. And they're just, to me, really good companies with a ton of cash flow. For that reason, I like the energy stocks right now. However, I am definitely not a financial advisor. People that try and tell you what stocks to get into, I don't think anybody's really very well positioned to tell you exactly what stocks to pick. I don't care how much of a financial advisor they are. No one knows what direction each stock is going to go in from, say, week to week, let alone month to month or year to year. But what I can say, though, with a little certain degree of confidence, is that if a company makes a ton of money and they're a great company, that their stock will go up over time. That does seem to be the standard, and has been for the last couple hundred years. However, I can tell you that the hedge funds do seem to be gravitating towards these kind of stocks in the near future. So let's go ahead and have a look at that investment grade portfolio that I was talking about earlier. Now, in this portfolio, you can see that I'm up 21.5% year to date. In the last 6 months, up 27.49%. In the last year, however, this portfolio is down 9.53%, and in the last 2 years, still down 5.04%. So what I can say is that 2 years ago was an okay year, was up a little bit. Last year was horrible, and then for like the last 6 months has been great. All told, I'm still down on the positions in this here portfolio. And then again, these are positions I don't really talk about. Now, I'm not going to show you everything in this portfolio because I am paranoid. There's this like little thing in YouTube when you can kind of go into and see who your audience is and who's seeing stuff where. And I think you actually click on an audience tab. And I had one video that came out where I had just hundreds of views and like quick, like rapid fire succession. And like 49% of all the views were from Nigeria, right? And so either I've never been to Nigeria, but either I can't walk down the street there without people wanting to take a selfie with me, or maybe there's some really smart people there trying to figure out a way to get into my bank account. So for this reason, I am very secretive about the amount that I hold, but I am happy to show you the stocks that are in this particular investment grade portfolio. So you can see this is a very conservative portfolio in varying degrees. I can't actually trade options on these. I don't actually own enough of any one of these stock to actually be able to sell calls on it or what have you. But it consists of a lot of mega cap tech, a lot of stocks that have a lot of money. We got Apple, Home Depot, Facebook, Microsoft, Exxon. I sold Nvidia. I rarely go into this portfolio and do anything with it. However, Nvidia was just up so much, I thought that I would sell my Nvidia and get some of these ETFs over here that I like a little bit more. I have Microsoft, ExxonMobil, Disney, Clorox, Visa, Foot Locker, Qualcomm, Kulik and Sofa. This company makes semiconductor chips. Like basically, if you are, say, Nvidia, they don't make their own chips. They have to send them somewhere to be made. And this is one of the fabs or one of the places that would make semiconductor chips. And this one's up all right. Wayfair is my dog here. However, I don't have enough money left in Wayfair to sell it. Like I'm better off just waiting to see if Wayfair just somehow goes to the moon than get a couple $100s for this thing. Google, and I have Amazon. Of my ETFs, of course, I have JEPI, love JEPI. And then when I'm selling Nvidia and I want exposure to newer stocks, I'm staying away from single stocks right now. I have all the big ones that I like, but rather I'm just going for sectors. And right now I like the energy sector, the healthcare sector, the financial sector, oddly enough, and the industrial sector. And so that's what this portfolio is. It's just a well-diversified portfolio. I chose industrials because I have no industrials in my single holdings. I have no financials in my single holdings. I have no healthcare in my single holdings. And that would be the reason why I chose those three. JPI, because I think right now it's the best stock going. If you had to put everything into one, probably JEPI would be the one to go with. As a matter of fact, I may or may not have a very, very large percentage of this portfolio right here in JEPI. Now let's go ahead and look at my trading portfolio. Now, for reasons I got into a little bit earlier, I try to be a little bit secretive about exact amounts in my different portfolios. However, in this one, I'm willing to show the options in this one. You can see that I had Chevron at $162.50. It was a covered call option that expires. It expired yesterday, except for however I rolled it. I closed it out. And then I opened another one that expires next Friday with a strike price of $165, and someone paid me $91 for that particular contract. You can see that in this trading contract, I also own Phillips 66, ConocoPhillips. I sold a put on Schwab. Right now, I think that it's a little bit oversold. I think that it's the 10th largest bank in America, and I think that this one's actually do fine. I have Marathon Petroleum, and I haven't been able to get a good value yet for Advanced Auto Parts. Now, the reason why I show you these things here is because this portfolio here, these types of stocks, they are down this year. However, the ones in the other one, they were up this year. And the opposite was true last year. And so what all of these companies that I have in common, well, they're at least the ETFs are all good investments. JPI is a great investment. These are all strong companies with a lot of earnings. All those companies were a lot of strong companies with a lot of earnings. Sometimes they have down years, sometimes they have up years. But at the end of the day, if you go to any one of these companies that I own in either portfolio over the course of a long amount of time, I will have made money, at least in the form of dividends, if not in the form of the underlying equity appreciation. And that's what I think is getting lost right now with all of this macro talk. And we're talking about the Fed and everything like that. I think we're losing sight of the fact of what the stock market really is. It's buying great companies at a good price, waiting some time, collecting dividends, perhaps selling calls, but just kind of waiting this thing out. And that's what the stock market is. And I'm afraid we're losing sight of that. And on that note, let's go ahead and talk about why I might have sold a put on Charles Schwab here at $52 that expires next week. This put was right at the money. It's currently trading at $52.38, so it's a little bit of what you might call a high risk. However, if you look at the price to earnings ratio, it's trading at 14.95, which is a discount to the S&P, which is currently trading at about 18.5. Its dividend yield is 1.91%. Now let's go ahead and look at an equity very similar to Charles Schwab. We'll look at Morgan Stanley. However, these guys also don't run a bank. They're totally investment banking, and their PE ratio is 14.27. However, their dividend yield is 3.53%. Because their dividend yield's a little bit higher, we'd expect that Schwab would trade at a little bit of a discount of 14.27, and it actually does not. It trades a little bit of expensive relative to Charles Schwab. Relative to Morgan Stanley. However, it's not that expensive. So let's see what it would have to trade at just to trade at a market multiple. So if all we have to do is we take this number here, 52.38, and we divide that number by 14.95, which is its price to earnings ratio, and we would say that Charles Schwab is making $3.50 a share this year. Now, if it traded at a market multiple of 18.5, we'll say, let's just call it 18, we could say that this stock should be $63 a share, just trading at a market multiple. So right now, $52 is less than the market multiple and similar to other stocks like it in its own sector. It's one of the reasons why I like Advanced Auto Parts so much. Right now, Advanced Auto Parts is trading at a price to earnings ratio of 14.71. Its competitors are O'Reilly's, which trades at a price to earnings ratio of 25 and has no dividend. AutoZone trades at a price to earnings ratio of 20 and has no dividend. Advanced Auto Parts trades at 14.71 and has a dividend of 14.93. I could argue that Advanced Auto Parts should trade at a higher PE than any of its competitors based on the fact it pays out a 4.93% dividend. However, if you pull the onion layers back a little bit, you will see that this company doesn't have as good of net margins, nor does it has similar growth, but not quite as good a growth as O'Reilly's and AutoZone. So it's not quite as strong a company, but one that shouldn't be trading at this price to earnings ratio. If AutoZone is trading at 20 and O'Reilly's is trading at 25, we would say that this one might be wanting to trade at about, say, 19. And so how is the price of Advanced Auto Parts relative to the market? All right, well, it's at 121.61 right now. If you divide that by its price to earnings ratio is 14.71, we could say that this company is making $8.26 a share this year. If we just do it at, say, let's say 19 times, AutoZone's at 20, O'Reilly's at 25, then this stock should be trading at roughly $157 a share. So we can see that there's a lot of upside to this stock. Now, this is why it's one of my bigger holdings also, because I think that this stock has a lot more runway and that sort of thing. And again, the market is just about buying great companies at a very fair price. 121 is a really nice price for this stock as far as my own research would indicate. I'm not telling anybody to go out and buy this. What I'm saying is that I believe that this one has more upside than downside. Now let's go ahead and take a look at that USOI investment. So I will tell you that I sold all of my USOI stock. Basically, that I got really scared. It was like the morning of Credit Suisse just collapsed. UBS and the Swiss government just bailed them out. All their AT1 bondholders just went like to zero. And if AT1 bondholders were going to go to zero, what was going to happen to my USOI stock? Well, I have no idea, but I wasn't going to wait around and find out. So I sold all of it at $70 a share. I ended up losing about 6,000, I want to say $6,900 on the position. But in any case, I figured it was worth it not to worry about it anymore. If I had held on to it, I wouldn't have lost anything. I'd actually be up right now. And I would have been up because they would have paid me that $2.84 a share. The X date was the 21st. I would have been paid on the 27th. The annual dividend yield is 42%. But again, I just wasn't willing to take the risk. I am a risky guy, but not so risky to let, all this money just kind of go to zero. So what are the odds that everything's going to go to zero for USOI? Well, let's find out here. So at least according to this article here in Business Times, their misadventure may be limping to an end. We don't really know, but will it go to zero? That's the important question. And after reading this entire article, I'll just give you the nuts and bolts of it. It says, of all the potential suitors for Credit Suisse, UBS is the bank most likely to leave the Credit Suisse products running, according to VettaFi's David Natick. Given UBS already has its own suite of ETNs, so it's already doing stuff like this, the bank has several other options it could pursue as well. The 4 Credit Suisse Extent ETNs have early call provisions, so UPS could absolutely just recall them, give everyone their money back essentially, but a more controversial option would be to delist without closing and basically taking the money from everybody. So the more likely option for this stock or this ETN would be to give everybody back their money. However, there is the chance that they could just decide to delist the stock and then everybody would lose their money. And that just wasn't a risk that I was willing to take. All right, so completely changing gears, we'll go back to my buying the house in England. It's currently actually owned by the same people that made that great food in the last video I made about going to England. It's owned by the people in that pub. I'm not going to really say what the pub is unless you go watch that video. But it's luck would have it, it's the same people that I featured in that video are actually people I might be buying the house from, and that's totally coincidence. It's like what a small world it is, except for unless you go into one of these small English villages, and then you realize it's just kind of everybody knows everybody. It's like like a really friendly place, and one of the things I really like about these villages is after 11 o'clock, you're supposed to shut down your pub. But in the case of some of these small villages, they just draw the curtains and they lock you in. It's called a lock-in. And you just get to stay there and you get to drink beer. And that alone makes it worth living in a small village. I get all the kebabs I want. I'm in driving distance to towns and cities. I get locked into pubs. That alone just makes it worth living there. And the people are top notch. Shout out to Rob and Izzy for going to check out, view the house today. Thanks you guys for doing that for me, because you can't actually buy a house in England without viewing it first. And people that I know in these villages, they're actually doing that for me. They're just first-rate folks. All right, so if you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. Until then, we see you next time. Have a great day. Bye. And now a word from my sponsor. Guys, have you ever been an 11-year-old Chinese kid locked in Disneyland because of COVID? Well, neither have I, but I definitely know the feeling because I've been locked in a pub in very small villages in England, forced to drink my sponsor this week, which is beer. Is that my imagination, or is the sun coming up? So my sponsor this week is actually Tonewood Lager here at Lumberyard, and I have to give this beer 5 Kate Rooney's out of 5. Cheers to Rob and Izzy for checking out the house, Dave and Bob for checking out the channel like you have done over the last year. You guys are amazing. Thanks a lot. Have a great weekend. Bye.